right, everyone. We're going to get started with our afternoon session. My name is Avery Wendell. I'm in Master's of Public Policy at the Kennedy School and an MBA at Wharton, and I helped put together our finance panel. Today we're going to be asking three core questions. One, what is the state of capital within circular initiatives? Two, what are the obstacles to larger capitalization? And three, what are potential solutions to those problems? To answer those questions, we've assembled a broad spectrum of people from the finance world. To start, our moderator is Professor GANDHI from Harvard Business School. He's written several cases related to sustainability. From Morgan Stanley's Global Sustainable Finance is Vice President Courtney Thompson. From Goldman Sachs is Justin Goldstein. From the UK DFID is ALESSANDRO MOSCUZZA. And from Boston's Green Ribbon Fund and LIGHTHOUSE Capital Partners is GWILL York. Unfortunately, one of our panelists couldn't be here due to travel restrictions, Dr. Shannon Bowden of McKinsey.org. So I'm just going to play a video from her statement, and then I'll let Professor GANDHI take it from there. Great. All right, ready?
Hello, I'm Shannon Bowden. I'm the Global Executive Director for Sustainable Communities at McKinsey.org. McKinsey.org is an independent foundation that was set up by the global consulting firm McKinsey & Company to solve some of the world's most pressing social and environmental challenges. So sorry that I can't be there today, but I was asked to record my answers to some of the questions to contribute to the discussion, and I'm very grateful to be able to be part of your conversation. I hope you have a terrific discussion, and I look forward to hearing how it goes. We work to break the cycle by developing collaborative solutions for both the supply side and the demand side. On the supply side, we work with communities to build self-sustaining recycling programs that capture the maximum value and amount of material from the waste streams and supply it into the supply chain at reliable quantities and at a better, higher quality through better efficiency, more training of communities as to what we're looking for, better training at the sorting centers as to what high quality material looks like. And then on the demand side, we work with multi-sectoral consortia to ensure that there is a stable demand and fair price for that material, such that those systems that we've set up don't collapse in the next economic downturn or the next time that there's a commodity price fluctuation. In combination, these two pieces by looking across the full supply chain and solving those problems, we feel that we can create an ecosystem that is conducive to more stable recycling and waste management, better waste management overall. I don't think that scaling is a problem limited only to circularity solutions. To be honest, pilots of many solutions often struggle to scale. I suspect that one of the major reasons is that they aren't designed for scale from the very start. One of the things that we see quite often is that a lot of money is thrown into pilot projects just to show that they can work, but they haven't thought about how those programs will stabilize after that money is gone, after the proof of concept is shown. Haven't thought about where that money would come from when they tried to replicate the program, and there aren't a whole bunch of exciting. That we see often is that funders are much more excited to fund that proof of concept than they are about how to replicate it. It's much sexier to be involved in a big project that's very exciting than to think about how do you create the second, third, fourth, fifth, 100th version of that project. So funding is also directed at those exciting, sexy projects at the beginning. I'm not going to say that we've solved the problem of scaling at McKinsey.org, but it is top of mind for us. All the solutions that we are trying in both Indonesia and Argentina are designed with scaling in mind. We aren't throwing a lot of money at this. We are throwing a lot of mental power at trying to create models that are easily replicable. So in Argentina, we are working in municipalities, and the idea there is to create a competition that ensures that cities that join us on the program have the minimum necessary enablers to make sure that the program will be successful. And we're also playing with the idea of cohorts of cities, where we would work intensively with one cohort with one city, and then that would allow other cities to watch and try and implement by themselves, but with lighter touch support from us so that we can reach many more than one city at a time. In Indonesia, this is taking the form of an academy where we're putting cohorts of communities through a very hands-on training where we actually demonstrate to them in their own sites and in a demonstration site what can work, so that we can teach multiple communities at once how to build these businesses that are actually self-sustaining in Indonesia and can provide compensation for the community, add to the income for the community. So it's an ongoing exploration for us. It's a puzzle that we are trying to solve actively, but I wouldn't say we have solved yet. I suspect that there is a finite number of scaling models that will work, but we aren't sure yet what those models are. What is clear, though, is that scaling is never easy, and there is no simple solution for this challenge.
Professor Gandhi, too.
Great. Thank you very much, and good afternoon to you all. First of all, I'd like to congratulate Avery for putting together a fabulous panel. We've got two representatives of some of the leading global financial services firms, a leader in developmental financing, and one of the leaders in the venture capital industry and in the private sector. And obviously, you chose an excellent moderator, so Avery, well done. It's when Avery actually called me about this. This is a topic I've spent most of my career in the financial services industry as well, financing various projects, et cetera, around the world, and got into teaching about 4 or 5 years ago, where I'm now at the Harvard Business School, really focused on sustainable finance. We have a new course I just finished my class and came here, which is on investing, risk, return, and impact. And a majority of that course is taking traditional tools of investing, of risk and return, and then bringing impact into that equation. Circular economies, climate, gender, income, essentially, again, using the framework of the UN Sustainable Goals as kind of the northern star towards which we should focus. So you probably heard a lot of the statistics that if we look at the UN SDGs, we need $7 trillion per year of spending. There's absolutely no way that governments and philanthropic capital is going to get us there. And the circular economy obviously being a key component of helping us achieve those SDGs. And that co-opting private capital in some shape or form is going to be critical in making that happen. Public-private partnerships, philanthropic capital, trying more innovative methods, and then straight equity, public markets, private markets, the fixed income markets coming together to kind of address these issues, where they know that they have the fiduciary obligation of generating market rate returns. How do you bring in important projects and impact into that equation? So with that, I thought we'd kick it off by asking Alex on the side, since he's representing kind of the government perspective here and the development financial institution perspective, is to tell us as to from whether DFID or some of your other peers, what are some of the key initiatives that you all have done to answer Avery's 3 questions, which is what's happened till now, where do you see some of the impediments, and then we can talk about solutions perhaps at the next round of discussion.
So thank you very much for the introduction and for inviting me here, Avery, as well today. So I probably bring a slightly different perspective from the other members of this panel, and I guess this is going to be one of the most interesting aspects of this session. I mean, we just had a quick exchange of words with 2 of my co-panel members, and we understood how the language we use and the environments we move in are quite different, not only in operational terms, but also in terms of concepts. So from our point of view, which is the government point of view, and specifically looking at development assistance overseas, I would say that this is quite a new field of operation. Until very recently, we were almost entirely focused on traditional development assistance sectors, which are really around education, agriculture, and environment and climate change came into the picture probably towards the end of the 1990s in more prominence. But circular economy is really something that has only been in the picture in the past couple of years. So the quick answer to your question is that the state of capital finance in that field is still pretty much nascent and evolving. We are putting in place some type of interventions in various portions of DFID, and Mario mentioned one of the previous panels, the Sustainable Manufacturing and Environmental Pollution Programs, which DFID is currently co-funding in partnership with UNCTAD, and there are a few other contributions to global multilateral funds. And the obstacles, just to summarize, are mostly around capacity in the field, both in terms of technical capacity and absorption capacity. I'm sorry, with the second term, I mean pumping sizable amount of capital into countries which might not have the apparatus to spend those finances effectively enough and quickly enough. So as for climate finance, I think one of the challenges we're facing in developing countries is to have enough technical and absorption capacity in the field. Yeah. Thank you.
Well, if I may, before I move on to the next panels, when you say that there's enough, that the issue is technical and absorption, that the implicit statement there is that there's enough capital to actually do it or spend. Is that true?
What is enough? How long is a piece of string?
Yeah.
So,
yeah. Well, it says about $2.5 trillion needed from the private sector to kind of go into these areas, and of course, obviously, a couple of trillion from the governments.
Yeah. I mean, at the global level, I think that level of finance is probably available. Looking at organizations singularly is probably not any single organization can bridge that gap on its own, and that's why we tend to work also with multilaterals, such as the big development banks, and also in bilateral collaboration projects with our institutions, such as the SMEP program, which we co-funded with UNCTAD.
And I think DFID, actually, you've been looking at from a developing country standpoint. I think obviously a big hole is spending on these topics in the OECD itself,
Yes.
right? So maybe I should pass that on to GWILL in terms of when you put on a private investor hat on and look at it from that lens, what is your perspective on this topic?
I had the good fortune of being an early investor in the clean tech area, starting in the 2000-ish, and had the opportunity to invest in cement companies, battery companies, Impossible Foods. We put Zipcar, all kinds of things into our green tech portfolio. There was a certain amount of optimism, and we can do this. We can make a big difference. But people, as was said earlier, were really excited about doing pilots, and if it didn't work out relatively quickly, then the bloom was off the rose and people moved on. So I think that one of the barriers is that people are not looking at a long enough horizon of time frame. So I think that that's something that we can all work on. Humans love to think in days and weeks, but we can do better. We can think multi-generational. And then another barrier, I guess I'm going to go through the barriers, but I think all of them are solvable. I think the financing will come. I think that in order to have financing come, you need to have a cocktail soundbite. I really am quite serious about this. That people can understand at a cocktail party, and because it's very easy for people to say, I'm doing a pilot, I'm doing this project, but that doesn't actually get us done. I actually cannot stand pilots anymore. I'm pretty sure we've piloted the hell out of a lot of things. I'm done with that. I'm really quite done with that. But I am looking for a cocktail pilot, anti-pilot soundbite, so please see me after the panel. We may not, in addition to not looking at it over the right time frame, we may not be thinking about it as this, what are we doing in the transition, and how will the world look like when we're on the other side? We're going to get to the other side. There will be a steady state on the other side. So I always like to paint a rosy picture. And then we may not be asking some of the right questions. So as Avery alluded, I'm involved with the Green Ribbon Commission here in Boston, and we look at organizations and people that are responsible for places and buildings and collections who are asking themselves the question, can we stay put? Well, they all want to stay put. Harvard is probably not going to go to Worcester. So what action should they be taking today and looking forward for 30 years? And so if you ask the question in sort of a two-part question, are we ready to move, and are we not ready to move? And how fast are we going to do this? And what are we going to do during the transition? And what will life look like at steady state? Because steady state's going to be better. It's going to be great. And we need to talk about that a little bit more, because I just can't stand to stay in the doom and gloom. So the money will follow if you paint a good picture and you invest over the right horizon, and if you look at the value that you're creating in transition and steady state, and I think it'll all be fine. So everyone relax.
All right, there we go. We can all go home now, Avery. No, thank you, GWILL. So that is definitely a 3/4 or 90% glass full approach to the issue. You know, you talked about steady state and coming out on the other side, which we obviously all hope will happen. The question is back to your long-term versus short-term thing, and you were at this conference as well on climate the other day, which we had over at the business school, where, you know, most institutional investors, while you talk to the large pension plans, they'll say when we talk about a quarter, it's 25, it's not 3 months, it's 25 years, and they'll have all that chat.
You're absolutely
but then
right.
It doesn't happen.
But the incentives for the CIOs and the pension funds, they leave after, they have like a high churn. They churn not quite as fast as chief marketing officers, but it's close. So we have an incentive structure problem for sure. But I do think that there are pension funds and wealthy families, sovereign wealth funds who are really looking at it long term. And you can structure deals that really do look at the long term. And there will be some very creative investment banking opportunities. There's a lot of creative financing. As you may know, Boston municipal buildings are going to be net zero by 2050. That's going to be a financing opportunity. And I'm sure that we will be able to do it, figuring out in order to do that kind of work, what's the additional cost? Is it only 10% more? Then you can strip it out and use the energy savings over the next 10 to 20 years to pay back the principal and interest. So I think it's just a matching of the liabilities and the assets, if you will, and just getting them to match up in terms of maturity. And we haven't quite figured out how to talk to ourselves about that.
So just on one last point, sorry to stay with you,
No, no.
but since you brought up the Boston buildings, right? So I was at some meeting a couple of months back, and clearly it's a big issue for all the government-owned buildings. But then there was, you know, everyone was kind of looking at it, well, how do we actually finance this? We don't have the money in the government to actually do it. And we haven't come up with a creative way where fiduciary money, pension money, or other kind of money can actually go in there and earn its rate of return. So how do you, are there ways that we've solved that issue now?
I don't think that we've solved it, but I think we're really, really close. And again, I am, I guess, a 65% full person. All right, we'll establish that. I'm a hopeaholic. I think that we're going to have to do it with in small digestible chunks. So let's say we do, like we work with Tracy Palangi or we come up with social finance, and it's a 20-year bond, and we're just going to keep going through building, municipal building, and you just keep it going. It's going to be an kind of evergreen kind of fund that you know has to make principal payments and come up with at least the something like the 10 or 20-year bond rate. And an interesting exercise at that conference was, if you look at the heat map, would you rather own a bond in Houston or in Detroit, Michigan? And that was really interesting.
Maybe you could, for the benefit of the audience.
For the benefit of the people out here who are not here, we're not really putting into our bond for municipal or any kind of bonds risk of climate change, wetter, hotter, those kinds of things. So if it's not, there are some great disconnections in the bond market. I wanted to go and start trading municipalities after that lecture because there was just so much to be done there. But I just put that out there, is that if you can say that you're borrowing money at Boston and you've done a good job of making sure that you are going to manage the heat, and you're going to manage the microbursts, and you're going to manage the tide rise, then you should be able to get a pretty good bond. And so I'm very optimistic that we will do that.
Great, thank you, GWILL. So if I may move to you, Courtney, and as GWILL mentioned, that large financial services firms have a big role to play here, and you know, for our course that we teach at HBS, we actually have a case both on Morgan Stanley and Goldman, and we teach it one day after the other, and then we have a lot of fun.
Could reprise that here.
But see, that itself is the debate. But Courtney kind of looks across all the different businesses. So maybe you could tell us as to whether it be the wealth management, investment banking, or your asset management businesses, what's been the evolution there, and how are you approaching the whole issue of financing the circular economy?
Absolutely. So at Morgan Stanley, as you said, we have 3 business units primarily. I would say it's really evolved across all 3 of them, sort of in the order you laid out. So I would say kind of going back, so our team internally was founded in 2009 to really think about this across the bank. Within our wealth management business, we launched a dedicated platform in 2012, and we've seen rapid rise in the assets under management there, really dedicated to what we call investing with impact, so broad environmental and social commitments. I think we've seen the demand rise quickly among individual investors, families, and small institutions that really care about where their money is going from a transparency perspective, really thinking about finance the way they think about their other consumer goods that they may be out purchasing. So we've seen that really pick up on the individual side. Out of our Institute for Sustainable Investing, we've surveyed individuals, institutional investors, asset managers. We've seen all the trends go up. We interview them and survey them every 2 years. The latest stats show that 85% of individual investors are interested in sustainable investing, which is a broad term, and that's even higher among millennials. Large asset owners, so globally, think pension funds, sovereign wealth funds, endowments, we're seeing well over 80% of them are also either actively integrating environmental, social governance objectives already into their process or actively considering doing that. So we've seen, I would say, the evolution move not just from the individual investors, but to the institutions. And I think what happens when you move in that direction is that you get longer term time horizons on average when you think about your investment portfolios. You get scale, you get larger commitments of dollars that are interested in funding these things. And then there's also been a great evolution, I would say, on asset owners coming together. So we've seen large initiatives like the Ceres Investor Network and others on the climate side, and we're seeing investors come together around common language and frameworks and goals, whether that's about picking investments or pooling their dollars together, or thinking about a framework for how they encourage companies to be more sustainable, more environmentally friendly, more circular. So I think we've seen that evolve. And so, yeah, then kind of our third business, so if you think about wealth management, asset management, and then investment banking, and I'm sure Dustin can speak more about this as well, but I think companies are really waking up to how they're being evaluated by investors. As a critical mass of investment dollars is thinking about these themes, I think companies are really responding, being more public about whether it's their pilots or really things that they're doing at scale. I think that's been an exciting evolution. And I think also just picking up on the pilot point, I think yes, pilots can be exciting, but I think investors, if nothing else, love boring. I think the more boring and the more repeatable you can make and understandable you can make the risks and returns of your investment, the quicker you will get to scale. And so I think that is a key piece of the ingredient that we're starting to see happen. I think take the evolution of the green bond as a great example. It's just a bond. You do ring fence your use of proceeds. There's also been an evolution of something called the sustainability linked bond, where your coupon, whether it's a revolving credit facility or a more of a bond structure, the terms that you pay will go up or down based on whether you hit certain sustainability metrics. But that's just a contracting term, right? That can happen. It could be, you can insert sustainability metrics, you can insert other metrics, but I think when it's clear and transparent to the end investor as well as the underlying issuer, that is when you can get scale in the flow of dollars. So I think challenges still remain around language. I think there's still a need for creativity, but I think keeping the goal of boring in the background is one that will, I think, drive more scale in the financing side.
But, so from an investment, when you look at whether it be banking side or your wealth management or any of the 3 divisions, the key issue so let's take the circular economy, right? You've got 5 companies in a particular industry. To really embrace climate change and change your business model, it's going to take some pretty big investment in the near term. And one or two companies do that and the other 3 don't. And you find that in a lot of these industries, the ones that actually have invested don't necessarily get some sort of investment premium. In fact, may even get punished for profitability declines in the near term. Are you seeing that, or are you seeing that mindset shifting?
Yeah, I think there's a mind shift with the time horizon that you're investing for. I think there's also been a much more sophisticated view as to the materiality of sustainability issues for companies. So when we think about our investment teams, and they're looking at companies in the same sector, they're going to understand, which circular economy issues are most material to that sector. Is it water? Is it waste? Is it plastic waste? We've made a big commitment around plastic waste as a firm as well, and how we think about helping our companies that we work with finance those solutions and how they can get credit for those. So again, not to over harp on it, but I think the green bond is an interesting way of signaling to the capital markets and investors how your use of proceeds that you raise as a company ties back to your sustainability strategy. And I do think that investors, whether they are investing directly in that green bond issuance or the stock of that company, but knowing that that's a transparent goal is driving a lot of conversation.
You are also on the bullish camp, as GWILL is, seems. We need some naysayers here. Are you gonna you're gonna say that, well, it may happen, but it's gonna happen 100 years later, that's not gonna help us, right?
Yeah.
Maybe you wanna talk about a little bit, since you're on the investment banking side, Justin, in terms of both what your clients are doing, what creativity is coming up about in the project finance area, and how is Goldman being a catalyst in that regard?
Yeah, I would say more broadly in investment banking, just to echo Courtney's comments, we've seen a huge, I think, acceleration over the past 6 to 12 months, where a lot of companies, I found myself, for whatever reason, kind of in a group within the bowels of investment banking that has been kind of a pioneer in doing a lot of recycling and renewable projects, which I'll talk about. But having done a lot of these transactions, people around investment banking and other parts of the firm kind of know about my business, and so the level of inbound calls has been really pretty incredible over the past. I definitely seen a major uptick over literally the past 6 months. I don't know what you've seen in your group. In particular, I do a lot of energy projects, and you may have noticed on some of the oil and gas companies like BP and Shell are saying they're going to get to carbon neutral. Their entire business is, petroleum. So how they're going to do that, I don't know. And I don't think they have any idea. They just felt like I think, the CEO of Shell says that, the CEO of BP has to say it. And it's interesting because I think, as you were talking about, like trying to make investments that are tangential to their business, when you're talking about a company where there sort of is no investment that's related to their business, their entire business is around, emissions. They could go into a lot of different things, I think, and it unlocks kind of a whole big sector that needs to figure out kind of how they're going to address these issues. And I do think they're serious about it, but I feel like we're at very early days with corporations, and I think the same is true of sponsors and private equity firms, pension funds, sovereign wealth funds, trying to figure out, they've announced very large goals. Some have stood up funds, some are saying they're going to create a fund, some are saying all of our investments are going to meet certain criteria or a mix of those things, and I think a lot of them are still just trying to figure out what that means and what they actually invest in. We've taken some companies to market, whether with strategic investors or private equity investors, and trying to get a sense of kind of what types of things they want to invest in. And I think like the surprising feedback we've gotten is they really, most of them kind of have no idea yet. They're interested in investing in wind and solar and some of these things that are mature. But around new businesses, new technologies, emerging things that can have a big impact, I think we're very early days in kind of understanding how the private sector is going to make investment in those sorts of things.
So I can understand the energy sector, and in fact, just the opposite yesterday, I think at Exxon's annual investor day, the chairman, CEO said exactly the opposite. We are the energy company, we're drilling, we're going to spend $10 billion a year in drilling, and that's what we're going to do.
Case,
that's it. But the point is that their stock price actually has not underperformed that much with the others. That's where the rubber hits the road a little bit. But in terms of any specific projects outside of energy, where if you look at just the business processes of moving from a linear economy to a circular economy and changing your whole manufacturing process, your supply chain process, are you seeing interesting project finance opportunities in that area as well?
Yeah, some emerging technologies. So I specifically work in a group that does tax-exempt bonds in the United States, and I do private companies that can, for whatever reason, do that. And as you point out, most of that's municipals, but it's a $4 trillion market, very sophisticated universe of investors. And there are certain categories that Congress has approved of private companies to enter that market. One of them is recycling of solid waste. One of them is industrial sewage. One of them is wastewater. So a lot of businesses can be financed in that market, and some have kind of figured out that exists. And it's attractive for investors because these are really different than investing the investors are interested in higher yielding, more interesting, impactful investments, and, by and large, that market is, AAA, AA, state and local governments, which have approximately no yield in today's environment. So we've had a lot of success financing here in the U.S., some really interesting recycling type technologies around plastic waste, wood waste, just garbage, scrap steel, e-scrap, manure, lots of different things. And businesses that are tangential to those sectors or operate in those sectors have definitely been interested in these companies and their technologies. We see some people enter in licensing agreements, make some investments, mostly kind of minority investments, but some. And so we're definitely seeing it. We've seen it in the packaging space in particular. We financed a project that's using straw to make straw, like when you produce wheat, you end up with straw, which is kind of a waste. In lots of places, it's just burned. We financed a project that's going to turn that into packaging, like molded packaging to replace single-use plastics and things like that. And the big packaging companies around the world are very interested in that company and their technology, and there's been some agreements to do some work around it. And similar in other areas in steel, we financed a company that's running a scrap steel mill, and that was just a big chunk of the company was purchased by U.S. Steel. So we're seeing a lot of interest from these type of businesses in some of this stuff, and I think it's kind of a narrow kind of spot doing this stuff in the United States and what kind of fits, but it has been a bit of a pioneer in the market. So we've seen some really interesting activity coming from that particular spot, and I think that will spread to lots of other financial products.
Thank you. That's very helpful.
Yeah.
So Justin's given us a perspective on financing in the U.S. Is that where your predominant focus is right now? You started off, Alex, by saying that some of the biggest issues you have is on the technical side and the absorptive capacity, probably mostly in developing countries. So if you look at, India or China, some of the other large countries which from a pollution, from an emission standpoint are right up there, maybe you could talk a little bit about how do you see that evolving in those countries, both in terms of the absorption capacity and their willingness to actually invest capital to advance the circular economy?
Okay, so I will answer that part of the question as best as I can, because I'm not a specialist in finance, and this is the challenge.
From your vantage,
yes. So first of all, to clarify a point I made earlier, absorptive capacity is mostly focused on low-income countries. So countries that are classified using the World Bank, income system. So we're talking about most countries in Sub-Saharan Africa and South Asia. China and India do not fall in that category, and indeed the technical capacity in those two countries and the absorption capacity are quite high. The problem with China and India is also quite different. In China is competitiveness, and really competitiveness on the global economic stage vis-a-vis the United States and vis-a-vis other large economies. So if you look, for example, moving a little bit away from circular economy, because again, carbon emissions and circularity closely intertwined, but not the same thing. If you look at the Paris Agreement and previous agreements before, and negotiations at the UNFCCC, the sticking issue has always been trying to lower emissions or decarbonize the economy, and the initial cost that would imply versus the long-term gains and benefit. And also links to the point that you made before. This is finance and capital raising, and returns on bonds and other financial instruments versus the actual business sense of investing in green technologies and reducing carbon emissions. Now, you mentioned 3 oil companies, one which is based in the US and 2 which are based in Europe. One is completely UK owned, and the other one is 60% Dutch and 40% UK owned. If you look at the policy and regulatory environment of those 3 companies, it couldn't be any more different. And that explains the different responses, and also why the shares performed and responded in very different ways. So if BP and Shell had come out with the same statements that Exxon did, I can promise you that the shares would have not performed as well as Exxon did.
They would have performed less badly. Those whole shares are done.
So I hope I answered the question by avoiding it
partly. Thank you, I appreciate it.
Thank you.
Sorry, did anyone want to respond to that? No? Yes? Okay. So GWILL, one of the things which you mentioned was this whole getting back to the long-term capital, and we were talking just before the panel about this book which you have over there, of the 20-year venture capital fund.
Drawdown?
Drawdown, yeah. How do we get long-term, we do need long-term capital on this, right? So it's beyond municipal bonds, it's spending money on innovation, on new technologies.
Yeah.
And most VC funds or private equity funds have their 6-7 year life, maybe 10 years all in, which maybe not lending itself to that, that's one. And two is, they also come in when the risk is somewhat de-risked, right? So how do we bring in more significant amounts of risk capital to solve this problem?
That's a really good question. I'm going to probably go back to wealthy families and sovereign funds and pension funds that should be taking a long-term view and can have a 20-year horizon, which is kind of what you need to really do this. And I think that if some people just would raise these funds, I think that they would actually find there's a market for them. You may have to change the 2 and 20, 2 and 25, 2 and whatever it is to make that be a little bit more appealing so the J curve is not as bad. But you know, it's just a matter of how you package it. So I'm glad that these guys did a 20-year limited
There's a
partnership.
breakthrough ventures too, right? The
Yes,
case,
they're
that's
they're
also
like
20 years.
yeah, they're like a handful of them now. So the fact that they've been successful raising their funds shows that there's an appetite for them, and so hopefully more people who have a right to create that fund and then pitch it to LPs will go forward and do that. So the ice has been broken. So I guess I would ask the question, who's going to jump in and do that work, and we'll see.
Yeah, well,
I definitely, if I thought that was a great question. This is kind of personally, not necessarily Goldman Sachs voice, but I think that Wall Street can play a big role in that because we have investment vehicles that help us win IPO mandates, especially in technology side. And we have, we lend a lot of money to companies, so we're in their investment grade bond deals. And I think that it would be a good use of Wall Street's capital to kind of turbocharge this sector. And maybe they need to pair up with some of these funds and people like foundations too, like the Gates Foundation is putting money into these things. But I think that there's a lot of exciting technologies and businesses out there that maybe the criteria isn't quite there exactly as you said for traditional private equity to get involved. But I do think that Wall Street should and can play a role in incubating these industries for sure. Yeah.
And Courtney, like Morgan Stanley has a massive private wealth business, like focusing on a lot of the high net worth families.
Yeah.
Are you I mean, it's one thing your kind of brokerage unit selling kind of an ESG product versus families proactively saying we want to invest in X, Y, and Z, which will address these problems. Are you seeing that, or what?
Absolutely. Yeah, I would say that's really where the crux of a lot of the demand out of our private wealth and broader wealth management platform has come from kind of in the early days, but that's really expanded more broadly. And I think the conversation has also become, I think the title of your class is around risk, return, and impact. I think we are consistently saying that's how we're seeing the investment equation evolve really writ large. I think investors, again, want that transparency, whether it's because of just an impact reason or because they see it actually as a long-term shift in the risk and return profile of where their investments are aligned. The shift to a circular economy, there will be winners and losers over the 5-year time horizon, the 10-year time horizon, 20 and beyond. And so how do you think about that relative to your own risk profile? And giving investors the transparency into what they own today, both on the risk and return side, as any brokerage firm has done for a long time, but increasingly giving them insight onto the impact and the social environmental impacts of their portfolio as well, which is something we're spending a lot of time on too, to empower our investors to be able to make those different types of decisions with their advisors.
One last question, and then I'll open up the audience and anyone can answer this. So we've talked about private capital, but a lot of innovation over the last 50 years, 100 years has really been in R&D facilities at universities, things sponsored by the government. And at least what I hear is that not enough of that is happening, and that not enough government money is going into innovation, and maybe good things are happening at universities, but it's not enough. Would you agree with that? Have any comments on that?
I wholeheartedly deny that.
You wholeheartedly deny that? All right, good.
I'm going to deny that. I think where it's hard is, as someone said, thinking about what the problem is that you want to solve. I've spent a lifetime looking in carefully at science projects. and trying to imagine how they might be useful to the world. And that is totally great. Basic science is awesome, but there's this thing that we're missing is kind of the people who translate the breakthroughs and try to get it breadboarded at a reasonable time frame and really not rely just on graduate student, ability to be interested in the project. So there's like kind of a breakdown in human capital at some level and really articulating what problem and doing a careful review of all the technologies that are out there. And I don't know really how to solve that one, but I have some ideas.
Yeah, because fundamentally, this is not incremental, right? This is the Industrial Revolution, 4.0.
Right, exactly.
Right? I mean, that's not just an incremental thing. It's a massive step jump. You disagreed as well.
No, if I can add a little
Yes,
point.
please.
So a fundamental difference from all my fellow panel members who operate in the private sector and people such as myself who operate in the public sector is that you have a common and constant, if you like, policy imperative, which is returns. Our policy imperatives can change when different governments get elected and can change quite dramatically, 1 year to the next or 3 years to the next,
Over
depending.
here every 4 years, but maybe not. I don't
Well,
know.
legislative cycles in Europe have been shorter somewhat, in recent years. So, but in addition to that, there's also a number of other, if you like, obstacles or challenges that you do not get in the private sector. So related to impact of spending, perceptions and public perceptions. In government, we must make sure that every single penny that is spent is seen by the public and by the media as being spent in an impactful way and being spent carefully. If there are issues of, for example, money that can be challenged to unethical companies or investment, I'm trying to use my words very carefully here. Perhaps if that happens in the private sector, things can be dealt with very quickly and more efficiently. In the public sector, that might lead to an inquiry and longer term. So there are more obstacles, and because we're spending public money, so again, it's a different operating environment.
Okay. Maybe I'll open it now for questions, and if you could just identify yourself and please keep it to a question as opposed to a long statement, if you will. Yes, the lady here. Yeah, thank you.
Hi, my name is Kezzy Chen. I'm one of the organizers, and I'm in the School of Engineering. And my question is, it seems like investments follow a balance between the appetite of the public opinion as well as returns. Switch your mic on. Oh, sorry. So it seems like investments follow a balance between the appetite of public opinion and returns. And I'm wondering which one will come on top. And also, do you think public empathy leads to correct decisions in circularity?
Okay. Maybe we start with one of you to answer that.
Sure. I mean, I think what we've always said, especially from Morgan Stanley's perspective, when we think about sustainable finance broadly, of which circular economy may be one objective. I mean, people come to Morgan Stanley because they want to grow their wealth, especially if we think about our private wealth business. So I think returns are always at the core of that conversation. That said, we very deliberately in our wealth business titled our platform Investing with Impact, because different clients have different definitions of what impact means to them. So it's been interesting for us to see over the last, since 2012 when we launched that, where dollars have flowed when it comes to different impact themes, and also coming out of different surveys we've seen of investors. We've seen the plastic waste issue, for example, rise exponentially and much more quickly than some of the broader climate issues, which have been very large and I think still have have a majority of investor focus. But when we look on the institutional asset owners, climate issues, resource efficiency, those are at the top of the list. So I think you will see differences in aggregate as to where dollars are flowing based on interest. But I don't think that those come at the expense of returns. And I think it's always, individual investors are going to have different objectives around different parts of their portfolio. But I think those two things very much flow together. And our job as an intermediary of capital, all of the banks really, is how do we help match supply and demand of those investment dollars? How do we make sure that we're bringing companies to market that are solving those issues and bringing in the right investor dollars that are aligned with that risk and return and impact kind of parameters?
Yeah, I think from what I've seen outside the government, most investors have been interested in having both return and having interest in the sector, having some kind of impact. So Yeah, that's what we've seen. They may have driven to some of these industries because they like the impact, but they've been looking for returns that make sense.
I think just one other quick thing I'd just add would be that there's, which is, again, it's all a lot of research, that the actual millennial and next generation is really driving, to a large extent, public perception, and we are seeing companies and pools of capital are reacting very aggressively towards that. So the reputational risk of having products and services and the way you do business, which is going to hurt, the younger generation who are going to be your major customers or your major employees going forward, while it was kind of an interesting thing to talk about in the past, but has become much more of a mainstream issue now. All right, should we take another?
Sorry.
You're the organizer. You're supposed to let all your attendees here.
Nabil Harfouch, I'm also from the engineering school, also part of the organizer. I'm just curious about something. So I heard about, I'm fed up with the piloting and so on, boring is good and so on. That's all good. We heard also earlier in a session about the importance of research and the new technologies that we will need in order to solve the circularity and all the other problems we have. And I work a lot with startups, and every time I see a startup going for some financing, the assumption is, of course, you have had a pilot project. Of course, you have a proof of concept. Of course, you have. So, correct me if I'm wrong. Are you not saying that you are divesting yourself from the risks of developing this technology? And don't we need to all collaborate on actually developing those technologies if we are going to find solutions?
Well, there is this concept called the Valley of Death, which is from getting the breadboard to like the pilot and then to getting it to the pilot scale. And it's been really hard to find that money for sustainability or for certain health diseases. It's just been hard. And there are a lot of people working on that, and it's a hard problem to do that. I would say that the technology is always advancing, so it's great that there are new companies and new technologies, but we haven't actually adopted all the things that we could be doing right now that are scalable. And so that's a different set of problems. So I think that we'll have to work on all of them simultaneously, and different people have different skill sets and are going to join into the effort at different places. But you're right to bring that forward.
And I would also clarify that I think boring is good from how you structure your financing. I think technology has a lot of room for innovation. I think there's room for innovation in finance too, but I think that to reach scale and more dollars coming in, I think the more clarity and pattern recognition you can get around the risks and returns.
And I think innovation in finance is really, really interesting, and being old enough to remember that we didn't securitize things. We didn't do leverage buyouts. We didn't do a lot of things when I was on Wall Street. So we have done a lot of innovating during my decades here. So I think that that's a really important part. There will be financial, hedge funds weren't even here 15 years ago, really. I mean, there was Farallon and stuff, but anyway.
All right, maybe we can...
We're going to back there.
Okay, back there.
Priya Krishnamurthy. I'm a Fulbright scholar from India. Recently, we've seen the whole unicorn-led narrative come under a lot of criticism. And in response to that, we've also seen new sort of movements almost, like the Zebras Unite, come up in the Silicon Valley. As investors and as members of the investment community and educators, are you also keeping or tracking such initiatives that are coming up? And how do you respond to these kind of cooperation and regeneration-led business model ideas?
Do you want to take that? Or?
I'm not sure I really understood the question, so.
So maybe you want to, actually, it's a good point. So maybe you want to clarify a little bit and how that kind of fits into the whole circular financing equation.
So, for example, a lot of the circular ideas or circular solutions that come up tend to be smaller solutions that might not necessarily scale up. And because investments, typically on investment organizations and agencies look for scale and at a very short time? Are we also trying to look at different kinds of business models that are not necessarily competition-led, but cooperation-led, which is what movements like the Zebras Unite are talking about?
For the
Which is,
benefit of the
again,
crowd, we could explain when you say Zebra Unite.
so Zebras Unite is a group of women who basically came out with a blog post in 2016 called Sex in Startups, where they criticized the whole unicorn culture and said that that needs to be reformed. And they came up with a whole manifesto on what a zebra company looks like, which is a complete opposite of what a unicorn could look like, which is regeneration-based, cooperation-based, and which does not only focus on scale as the end result, of an enterprise.
Okay.
So, and that's organically grown now with a lot of people wanting to invest, and it's largely millennial and Gen Z led. And it's happening all over the world. And it's a movement that has also been responded to and has been highlighted by LinkedIn as one of the top sustainable movements that is going
so
to...
I guess the question really
The question
would
is,
be,
therefore, as the investment community, are you aware of such movements, and are you responding to it in how you shape your policies?
I think I'll take that. I think that when I look at it as a person, I am very involved in the zebra movement of taking small scale, doing cooperative work, going person by person and hoping that whoever I touch then goes on and touches other people. Absolutely. I'm not sure I can really put it into the business model of a fiduciary that we all kind of have up here, but there isn't really a separation when I'm a parent, okay? So I used to have a list of what I did for my kids and what I did for my business because I've started businesses. I only have one sticky now. It has all the things that I have to do. So I would ask everyone in the room and anyone who's in finance to make sure that they have that connectivity and that personal convening that will scale, as you say, even though it starts small, it definitely scales and it definitely grows, but it's not an either or. I think you just put it on your list of things you need to do every day or every week. I would encourage you to just keep speaking and just ask people to work on doing that in their lives.
Yeah. Maybe we take a question from this side, maybe to this gentleman here.
Thank you. My name is Graham Sinclair. You can find me at ESG Architect. I'm currently co-teaching in the Kennedy School on resilience finance. How do we invest in the melting Arctic? Something that I've seen the students struggle with is facing a changing situation, having great empathy, having a variety of skills and experience. But the one thing that keeps coming up that kind of underpins where the study group has got to is, what do we need to stop doing? And what do we need to do more of? Put more plainly, the ideas shared today, is it worth the cash and carbon cost that it took to get us here? If we consider how many new things everyone gathered here will start to do and how many things we'll stop doing. And here we speak of finance, so we think of money. So I'd like to hear from the panel, do they feel the sense of urgency? 2 days ago, CalSTRS had their quarterly investment meeting. Brian Deese from BlackRock had to defend a lot of their work in sustainable investment. There was some excoriating public comments on how slow, for example, this mega investor CalSTRS was in moving the game forward. Are you feeling predatory delay, going slowly in the right direction, or urgency about getting there faster to the circular economy, not just the climate issue, but circular economies, not linear economies? So I'm here to learn about the urgency.
Okay, fair enough. Maybe I'll turn it over to both of you, and then also from a government standpoint, are you seeing enough push? But maybe one of you all can take this.
I think I mentioned we've seen like an acceleration. I do think there's a lot of businesses, especially in certain sectors, that are feeling a lot of pressure. And a lot of these conversations around projects that I've worked on or some of the companies I'm working with seem to very quickly percolate from, there's not, the group that does investing maybe at a strategic company to all of a sudden, the CEO or board members or someone at that level is involved in the negotiation or discussion around a small investment in a little business or something like that. So I think that has accelerated a lot, especially in the energy sector, because all of a sudden a lot of companies have been, feeling, I guess, pressure to make these announcements. They're going to change their business, kind of starting with I don't know who was first, but like, you know, Microsoft and others like making, you know, technology space, making these announcements, they're going to recoup all their carbon. And then, you know, so I think this has happened very quickly. And we've seen at Goldman anyway, a big acceleration and the focus on this stuff. So I don't know if there's a panic mode yet. It does seem like in the hardcore oil and gas refining companies, there is a little bit of panic that millennials don't want to buy their shares anymore, period. And that's going to become like a crisis not too long.
But I think it's gone even beyond millennials not buying their shares. I mean, the key issue really is there's this whole issue of stranded assets that you must be very familiar with, that from a pure valuation standpoint, there was a thing in the Financial Times that, you know, if you have to meet the target of 1.5 degrees, you're essentially going to have $900 billion of market value kind of wiped off from the oil and gas industry, right? Any perspective on the government spending on this?
So, yes, there is a lot to say on this. But first of all, the policy of regulatory environment, as I said before, is crucial to this, and that goes back to the previous. But if you move away a little bit from just finance and think about operational reasons, and think about companies which make and produce and sell goods, commercial, everyday domestic, so Procter & Gamble, Unilever, they're all moving to a different, sub-Miller breweries, into a different model, not just because of all the issues you mentioned, but because from a business perspective point of view, it makes sense. These people rely on water. These people rely on natural resources in order to produce their goods. And it is not just an issue of corporate social responsibility and public image and investor confidence and policy and regulatory environment. It's also a question of business sense. And I remember when reading The Economist and the Financial Times, I think it was Paul Polman, the CEO of Unilever, said, we are going to go fully sustainable, fully circular. And the shares had a little blip for like 3 days. And then they've been going up ever since. And everyone thought for a couple of days, oh, Unilever is ruined. Absolutely not. And everyone is following suit. What was the second part of the question? Too much.
Yeah,
okay.
No. That's
Professor Gandhi.
But one comment on that, though, because I think it's important, is the, you know, while for everyone gives the Paul Polman and Walmart and a few others, you know, you can typically count there like 10 companies which people keep on repeating, and maybe that company's gone now to 50. It's just not enough, in my view. And essentially, while there is more urgency, as we see, and a lot of the financial services firms creating all these ESG products, the fact of the matter is that the public markets where a lot of the circular economy needs to happen, the underlying companies which are traded, 40 to 50% of them are owned by passive asset managers, BlackRock, Vanguard, and State Street. And they own these securities in a passive way through ETFs and through index funds. And so I think the big issue, which is, again, we were talking about the other day, which was focused on climate, but somewhat linked, obviously, to the circular economy, that if you're owned 40 to 50% by passive asset managers, you have to change a business model to actually make them active to accelerate the transition. And I think that's, so when Brian Deese gets pressure on it, BlackRock owns, 7 trillion, but 4.5 trillion of that is passive, where they own 6 basis points for managing the money. And if you're going to cover 5,000-6,000 stocks with 50 people, I'm not quite sure how deep you could get into the issues. So I think but the encouraging part, because I also want to be a half glass full kind of person here, is that there's a massive recognition that something needs to give here, and sometime quite soon. So sorry.
If we can get our last question from the online audience.
So MAP is asking, what are the panel's thoughts on keeping the circular economy and benefits of a circular economy equitable and inclusive, especially of the most vulnerable, and to the adverse impacts of climate change? So just for those coming later, we have an online audience of around 100 people there.
Fair enough. I mean, I think DFID spends, as you said, a lot of time in sub-Saharan Africa, South Asia. How do you see the impact? So the question was about, as you look at the impact of the circular economy, how do you make sure that the most disadvantaged people are protected as the world transitions?
Yes. So first of all, I don't see a problem for people in developing countries as being affected negatively by the circular economy. If anything, they can only be affected positively. every single project we've been implementing in developing countries, which has had the circular economy dimension to it, has been nothing but beneficial to people in those situations. So, for example, take waste management. One of the initiatives we implement in various countries in sub-Saharan Africa is to work with waste pickers, who are at the moment working in formal settings in abhorrent conditions, really horrible conditions, and no guarantees and no safeguards, and they do recycle various types of goods. And by formalizing the sector, by making sure the recycling enter the mainstream, economic activities of those countries, the conditions of people in those circumstances can nothing but improve. So far, the picture has been rosy. So
one more thing I would just add too. I think a lot of the investment solutions on the circular economy are often tagged as being an impact investment, right? Thinking about a positive impact. I think along with that, and people like to kind of wave their hands over the ESG acronym, but I think that looking at the material, environmental, social, and governance issues of any investment that you're making, whether it's meant to have a positive impact in some way, like reducing waste or making waste more circular, I think if you overlook those other social, environmental, and governance issues that go into any investment, I think you have a risk of overlooking some of the unintended consequences in the social issues. And so I think that having a bare minimum kind of view of ESG, again, whether it's an impact investment or not, I think is critical to the process.
And because I can't help but look through the rose-colored glasses, here in the Boston area, very, very, very local, 3 reports that the Green Ribbon Commission produced. The third one was on equity, looking at the low-lying areas in the Boston area, because where people are on landfill is where our poor communities, are under-resourced area people live. And so we have to make sure that we protect those areas first. And that has been what the city of Boston and the state of Massachusetts are going to do. So that's it. It's not just an international problem. We have those kind of issues right here in our own city.
Thank you for pointing that out. I think this.
Could you get one more question from the back?
Sure, okay.
There.
I thought you wanted.
Can you hear me? My name is Ashish. I'm from the Kennedy School, but I also do some work with the UN, specifically on the SDGs. So I guess my question here is trying to zoom into the granularity of the regulatory framework. I mean, it's good to say, we can regulate this away, and that's important, But if you look at the example of the climate change discourse, where essentially the world legislated to agree to limit to 1.5 degrees, of course, I mean, we won't, but we have the blueprint, and because of that, we could come up with the term of stranded assets. Now, is that framework where essentially we are putting a limit on, let's say, the amount of plastic in circulation in supply chains per industry or something like that, is a useful regulatory tool for finance to be able to decide which direction it wants to go in, to say, oh, we need more regulation, I mean, that's fine, we need appropriate regulation, that's okay as well, but to essentially put limits on, I guess, I mean, you understood the question, so I don't want to get into more detail, but yeah, that's...
All right, does anyone want to take that?
One comment I would have on that, I think when you think about the Paris Agreement and carbon emissions, right, someone made the comment earlier on a prior panel about there's no kind of US climate, European climate, Asian climate, right? The climate and global warming happens writ large. I think when you think about certain circular economy issues like plastic waste, there's more of a hyper-local issue with where does waste get collected, where does it end up in the global supply chain? And so I think, while I'm not an expert on kind of where and if and projecting if there would be a global agreement on kind of total plastic, for one example, I do think that there will need to be a lot more nuance around physical waste and where
the global agreement on plastic is being discussed, oceans and microplastics.
Great.
But I was, yeah.
Sure, but the point I'm trying to make, right, is that I think there needs to be a much more global, regional, country level view on how you manage physical waste, because that impacts physical areas, specific cities, specific neighborhoods in a way that is distinct when we think about carbon emissions.
You want to answer that? So I would just, yeah, go ahead.
Well, I would say, I think that a lot of the tools that have come out of legislation and government to help enforce like some of the carbon credits, and there's RIN credits in the United States, and there's certain credit programs in California and some other states, Canada, around emissions and other things that like the policy was trying to drive towards. I think that those A lot of those tools, I think in practice, we can learn from how they've worked out, because I think a lot of them in actual practice aren't necessarily driving the type of investments and the change that was wanted. So I do think like a lot of work and more collaboration with kind of the finance markets would be helpful, because I think a lot of those tools have been driven by policy folks or folks that, you know, spend a lot of time in government and bringing more kind of the private sector into some of that stuff, because it hasn't quite, you know, worked as efficiently as I think it ought to or it could.
I mean, just to conclude on that, I think you've got to have, it's not either or. We have regulation, we have private sector, but having the reason why the private sector or the financing sector specifically, I think, pushes for regulation is because then you know under what kind of framework you're operating under, right? And again, the most I keep on hearing about is that we need to have some sort of carbon tax. And it's kind of that's a market mechanism in addition to whatever regulation that you want to put in, which will help accelerate the development of the circular economy and climate control, and emissions. But again, you know, the climate is all over the world. If you have carbon tax in one area and not in the other, are you actually going to solve the problem? So this is a massive issue. You want to take more questions? Are we done? No. Yeah, okay. This is a massive issue. I was very, very pleased to see a high degree of optimism on the podium here, which is great. There is a lot of focus on this topic, you know, probably not enough. And I think there needs to be a lot more dialogue between the public sector and the private sector to kind of move the ball forward. It's a collective action problem. I mean, when you have a collective action problem, you're from Kennedy School, so you know, a collective action problem with a 50-year time frame is a seriously difficult problem to solve, which is really what this is about. And so it's never going to be an easy solution. It's going to be incremental, but I think the level of urgency that we've kind of reflected over here is in play. So with that, please join me in thanking our panelists for the discussion. Really appreciate it.